Welcome to you all. Thank you very much for joining. I'm Virginia Birrell, the CEO of the Australia-China Business Council in Victoria. Delighted to welcome you here today for this very important briefing where we'll be unpacking the latest and most comprehensive reforms to Australia's Foreign Investment Review Framework since the introduction of the Foreign Acquisitions and Takeover Act in 1975. Please note this session is being recorded and we will provide key takeaways to you next week. Australia's Foreign Investment Review Framework strikes a balance between facilitating investment and protecting Australia's national interest and is critical to Australia's economy and prosperity. These reforms aim at ensuring Australia's foreign investment framework keeps pace with emerging risks and global developments in three broad ways: by addressing national security risks, strengthening the existing system, and streamlining investment in non-sensitive businesses. To explain in more detail and to answer some of your questions around how the changes will impact FDI into Australia, today I am delighted to have with us Roger Brake, Division Head of Foreign Investment and Trade Policy at Federal Treasury and Executive Member of the Board of the Foreign Investment Review Board, Andrew Deitz, Principal Advisor of FIRB, and Malcolm Brennan, Partner at King & Wood Mallesons. Today also I'm delighted we have our Victorian ACBC President and China business expert, Matthew Schofield from Shinewing, to moderate the session's Q&A. If you would like further details on their bios, please refer to the detailed PDF sent to you with the link for this event. On that note, I will pass you over to our first speaker, Roger Brake, for his opening remarks and presentation.
Thank you very much, Virginia. Welcome, everyone. We are very, very pleased to be able to join you today virtually. We are doing quite a lot of stakeholder engagement following the Treasurer's recent announcements around the foreign investment reforms, along with the Foreign Investment Review Board itself and David Irvin. Firstly, I'd just like to note that the ACBC is a very important stakeholder of the Foreign Investment Review Board. We've had many engagements with the ACBC in the past, and we certainly welcome the relationship. David Irvin, as chair, delivered a speech to an ACBC event in Sydney in August last year. Of course, that was back when we did these things in person, but it is nice to have this opportunity. And I'd also like to thank you and your members for your support and understanding since the introduction of the temporary changes, the $0 monetary thresholds that were announced in late March. Andrew will talk about that in more detail going forward. But we certainly recognise the importance of this relationship and the importance of Chinese investment into Australia, along, of course, with investment from all other countries as well. But a critical thing is that Australia relies heavily on foreign investment for its prosperity, for its jobs, for investment, for technological know-how, access to markets. All of these things mean that foreign investment has been in the past, is now, and will continue to be really important in Australia's future. And we are, as the FIRB and as Treasury, we are seeking to be as open and transparent and as consultative as we can be. We recognise that these are very important changes, that there's a lot of interest in what the FIRB is doing, and we need to be out and engaged. And of course, we all know that China continues, as I said, to be a very important player. So let me turn to the Treasurer's changes. On the 5th of June, the Treasurer announced these major changes. As Virginia mentioned, we think they are the biggest changes to the regime since its introduction in 1975. There are three main elements to them. firstly, new national security powers. Second is strengthened compliance and integrity measures. And thirdly, and very importantly, streamlining investment in non-sensitive businesses. It is important that our framework continues to evolve to meet contemporary needs. I think one of the great benefits of Australia's foreign investment system has been its flexibility, the fact that we have a national interest test, which is not defined in legislation, which then enables it to respond to the issues of the day. But what we have found in recent years is that there is this need for reform, and that principally comes about from a range of factors, including rapid technological changes, changes in the international security environment, changes in government policies, including privatisation of assets and the like. So the proposed reform package will modernise the framework. It will allow it to respond to emerging challenges while continuing to balance maintaining public confidence and Australia's attractiveness for investment, as well, of course, the key role of safeguarding our national interests. Now, in some ways, what Australia is proposing to do brings us more into line with other countries. So prior to the coronavirus pandemic, many other countries were also strengthening their foreign investment rules for similar reasons to those I outlined, including the US, the UK, the EU, New Zealand, Japan, and China. And in fact, the OECD has found that between 2017 and 2019, 9 out of the 10 largest economies in the world either modified or introduced new measures to manage acquisition or ownership-related risks regarding essential security interests. So, there's a number of countries are evolving their systems for those types of reasons. Now, the other critical point and a fundamental part of our system is that we remain open, transparent, and welcoming. We treat all investors equally, regardless of where they come from. There is continues to be no part of the Australian economy which remains off limits to investors from any country, and that remains a really important part of our system. So let me just step back in terms of the national security powers. So currently, foreign persons must seek approval for investments above certain thresholds. Now, those thresholds are dependent on the sector and the country of investor. So foreign government investors have faced a $0 screening threshold, and that has been in place for a very long period of time, and that's across all countries. But private investors have higher thresholds. Most private investments under $275 million, or in the case of free trade partners, $1.2 billion, are not screened. And I guess increasingly we became aware that that was a concern in terms of national security, because what this meant was that there is the potential for investments to be made into Australia by foreign investors, which could give rise to national security risks. And because they were below those thresholds, they were not able to be screened. There was no legal requirement for those investors to notify the Foreign Investment Review Board or the government. The other point here is that some of those sectors, some of those low value investments are particularly vulnerable, as their specialised expertise often means that there's a large number of small new firms with valuations which are much lower than the existing thresholds. So in the world of technology, you can have an investment that might be relatively low in value but might still give rise to significant national security concerns and therefore warrant foreign investment scrutiny. So to address those risks, a new national security test will be introduced for investments that raise those national security concerns and which fall below existing monetary thresholds. Now, understandably, we've got quite a few questions. Malcolm and I were at a meeting with the Law Council, a lot of interest in exactly how the new national security test will interact with the existing national interest test and exactly what businesses will be treated under the new national security test. So the existing national interest test will remain unchanged. So those thresholds, which at the moment, of course, are temporarily reduced to zero, but in post-coronavirus pandemic world, will revert to the normal levels. So that the national interest test and those thresholds will remain as they are. And of course, the national interest test, which is not defined, but typically includes things like the character and the investor, competition, impact on the economy and the community, other policies such as tax and national security. That sort of framework for assessing those sorts of cases, those larger cases which are caught by the national interest test, that consideration will remain. The new national security test will be for investments that raise those national security concerns but fall below the existing monetary thresholds. And for those investments, they will be assessed only on national security grounds. So if you're only subject to screening because of the national security test, you are examined against national security. Now, where you could potentially be subject to both tests because you've got a large investment in an area which might give rise to national security concerns, you'll only be subject to the national interest test. And the reason we can do that is because national security is already a component of the national interest test. So we don't need to separately test you for both national interest and national security. So there's 4 parts to the new national security arrangements. First, there is a group of businesses for whom it will be mandatory to notify the government of their acquisition. So a foreign person proposing to start or acquire a direct investment in what is known as a sensitive national security business will be required to seek approval prior to taking action. So in a sense, this is a bit like how it works, how people would be familiar with the existing national interest test, in that if you fall within that definition, you need to seek approval before you make an acquisition. And I'll talk a little bit about what will be covered by the sensitive national security business. So that's the first part, a core group which requires mandatory notification. Then the issue is, well, what about businesses that might not fall within that category, but which might nevertheless still give rise to national security concerns. So we don't want to have everybody in every business in Australia potentially having to come into us. So we define that first set, but then to give flexibility, there will be what's known as a call-in power. So the Treasurer could call in an investment for review on national security grounds, either before the acquisition has taken place, if we become aware of it and there are concerns, or after the acquisition happens. And this is a fairly common feature in foreign investment regimes in other countries. Now, importantly, we are also going to be offering a safe harbour, because we recognise that for some businesses that might be unsure whether they might, or for some investors that might be unsure if their investment might trigger a national security concern, they might want to know that before, for example, before they make the acquisition. So whilst it wouldn't be mandatory for them to notify us, it will be open to them to notify us. And if they do notify us, then they will be subject to examination by the government, and that then really them being called in afterwards. And then the final element of this is that under a limited set of circumstances, hopefully people can still hear me. I've sort of lost a bit of video, but hopefully people can still hear me. And the fourth element of this is as a last resort power, where an approval has been granted, there'll be a power to review that approval, again, strictly on national security grounds. Multiple safeguards will apply to that. So they're the four elements to that. And I should say at this stage that there is quite a lot of detailed information which is available on the FIRB website, and in particular a thing which we call the summary booklet, which has quite a bit of information in it. So there's a lot of interest in what is this sensitive national security business? How do I know if I need to come to government before making an acquisition? That definition is going to be consulted on and defined in regulations. For the consultation purposes, the government's proposal is that it includes a business regulated under the Security of Critical Infrastructure Act, which are certain assets in the electricity, gas, ports and water sectors, or the Telecommunications Act of 1997, businesses involved in the manufacture or supply of defence or national security related goods, or the defence estate or other core defence interests, businesses or land situated close to defence or national security installations, or businesses that own, store or collect sensitive data relating to Australia's national security and or defence. But as I say, that is, if you like, it's a working definition, and the government is certainly keen on having quality consultation on those matters. I mentioned before that another focus of the reform package is on compliance and integrity. We have, over the past few years, seen an increasing use of conditions in order to grant approval for foreign investment. And those conditions are put in place where the Treasurer is satisfied that they are needed to ensure that something is not contrary to the national interest. And at the moment, about 80% of business applications by value have conditions attached to them. So what we've seen is a growing stock of those cases with conditions. Clearly, like any other area of administration, conditions and approvals with are only really require effective compliance to ensure that there's community confidence that people are making good on what those conditions are. Obviously, if we impose conditions and they're not being complied with, then that means that national interest risks remain. So we and in the Treasury and the ATO will have stronger and capacity to monitor and enforce conditions. Essentially, what will be happening is that we will get a similar regulatory toolkit than other regulators like APRA and ASIC, plus a more flexible range of penalties, because at the moment our penalties are pretty blunt, and they don't, for example, provide things like infringement notices, which are again a common feature of other regulatory arrangements. Then finally, the streamlining measures, which have also been of considerable interest to stakeholders. And here we are looking to streamline the approval process for passive investors. And in particular, the government will exempt certain investments made by entities who are currently classified as foreign government investors. So the exemption will, of course, remain non-discriminatory and will only apply where the foreign government has no foreign government, could be seen as having influence or control over the investment or operational decisions, where it's seen that the foreign government, whichever foreign government has that sort of control, then that exemption won't be made. And this will mean that some passive investors won't be treated as a foreign government investor and therefore won't have the $0 monetary threshold that foreign government investors have, and instead they will have the relevant private investor threshold, which, as I mentioned before, can be up to $1.2 billion. And again, those measures are available in the summary booklet. I might just quickly move on to implementation. We recognise this has been a very it's been a very busy period for us in Treasury. It's been a very busy period for people like Malcolm. I can see Malcolm nodding, and it's obviously a period of time where there's been a lot of change for foreign investors investing into Australia, with both the temporary changes and now these changes. So we recognise the importance that we get the implementation right and we get the consultation right. To that end, the government is very committed to that. The reforms are scheduled to commence on 1 January 2021, subject, of course, to the passage of the legislation through the Parliament in the second half of this year. So we've obviously, there's been the launch, we're having engagements like this, and the next stage in the process will be the release of exposure draft legislation. That is scheduled to be released around mid-July, and there will be a 6-week consultation period. So that will be open for 6 weeks for any party, investors, lawyers, foreign governments, anybody, to make submissions in, and then we'll obviously be considering those submissions. The government will consider those submissions, and then, as I said, the legislation itself would be introduced into Parliament, later this year in time for it to be passed prior to 1 January. We also obviously encourage people to keep a lookout for changes as notified on the Foreign Investment Review Board website. We've been putting together a lot of guidance, for example, on the temporary thresholds, and there's been some changes to that guidance as experience dictates. So encourage people to do that. And look, I think with that, I will leave it there. Happy, obviously, to take questions once we've gone through the presentations. Thanks, Virginia.
Thank you. That's terrific, Roger. Andrew, would you like to make your presentation? We'll hand over to you, both in the one room, which makes it easier. Thank you. Thanks. Thank you.
Very high-tech approach to handing from one to the other. So thank you. So I won't spend a lot of time on the temporary changes, in part because they've been in place for a little while now, but it is a good opportunity to recap what they were and why they were put in place. So the temporary changes to the review framework were announced on the 29th of March. The main components were reducing all monetary screening thresholds to 0, which effectively means all foreign investments subject to the Act will now require approval. And we also extended the review timeframe from 30 days to up to 6 months. These measures were necessitated by extraordinary circumstances, which necessitated extraordinary steps to protect Australia's national interest as the coronavirus pandemic puts our businesses under intense pressure. The temporary measures provide assurance to the Australian community that there is appropriate scrutiny over foreign investment during these challenging times. Australia has not been alone in taking steps during this crisis. Many other countries, including those in Europe, Canada and Japan, have also introduced similar measures during the pandemic. Acknowledging investors' concerns with the timeframe, we continue to emphasise the measures we have taken to ensure the great majority of applications are processed much faster than the timeframe of 6 months. We've brought on additional staff to manage our caseload, and we've developed a triaging method to prioritise the urgent investments to directly protect and support Australian businesses and Australian jobs. The triaging methodology considers the risks and criticality of each application and the appropriate delegation authority, informing a decision on the approver and the timeframe for that approval. To demonstrate, we have processed some critical proposals during this crisis in less than a week, undermining our long-running commitment to work within commercial deadlines. In the months since the announcement, Treasury has been in close consultation with foreign investors, lawyers and business groups to address concerns, questions and uncertainties raised by the temporary changes. Treasury drew on these consultations to provide guidance on implementation issues on the FIRB website, initially through a question and answer document and later through a standalone COVID-19 guidance note that has since been updated a number of times. I'd encourage anyone who hasn't had an opportunity to review that, if they have questions about our processes during this time, to go to our website and to have a look at that note. But to emphasise one of the points that Roger has made, the clear message that we have also been communicating with stakeholders, which we'd like you to take away today, is that Australia remains open and welcoming to foreign investment while ensuring our framework is adequately equipped to assess investments against our national interest during these challenging times. So since the 5th of June announcement by the Treasurer of the reform package, which Roger has just walked through, the common question we have received is how the temporary measures will transition to the reform package. The announcement of the foreign investment reform package does not immediately affect the temporary measures. Although the economy has started its recovery, the coronavirus outbreak still presents risks to the Australian economy and to Australian businesses. The Treasurer has said the intention is for a seamless transition from the current temporary arrangements to the new system, which, as Roger has said, is scheduled to commence on the 1st of January 2021. Under the new system, mandatory screening of investments in sensitive national security businesses will continue at the current $0 monetary threshold, and any business that raises national security concerns may be called in. For all other investments, it is intended the temporary screening thresholds will not continue beyond the commencement of the new system, of course, subject to any adverse developments with respect to the coronavirus. And with that, I might pause.
Andrew, now we'd like to head into the question time. If I could hand over to Matt Schofield to run this session, and Malcolm Brennan will also join in with some of the question and answer. Now, the information was, or the questions were submitted by our attendees prior to the event, so I'll hand over to you, Matt.
Thanks, Virginia, and welcome everyone to the Q&A session for today's webinar. As Virginia touched on, the questions were pre-submitted, so we'll work through those, and if there are other questions coming through, we'll do our best to address those as well. And the first question that was pre-submitted is slightly vague in the context, so it's a bit open-ended, but it does reference the new national security test. And I think we've covered how it differs from the previous arrangements, but I think what some of the listeners are keen to understand is what it will mean for particular sectors. I think we have a bit of a sense of what it will mean for some of the more critical infrastructure type sectors, but I think it's a question that's directed at trying to understand how far reaching the national security test can be. So does it extend to sectors such as mining? Where does it cut in and out of energy? And also I think infrastructure to the extent that it moves into transport, roads, etc. So keen to hear from our panel members what their views are on where national security can sort of cut in and cut out.
Terrific. Okay, well, I can start. So I guess there's two things here again. One is the mandatory notification. So that's where it would be illegal to acquire a business without getting approval. So that's called the sensitive national security businesses. That will be defined in regulation. And there will be this consultation period on that, and obviously we will be seeking to give as much certainty as we can around those arrangements. We've got this draft working definition, if you like, but that is certainly something that will be well articulated in the regulations. The second element is this where you're not covered by that definition, and of course you're also not covered by the existing national interest definition and the thresholds. You're in this sort of this third group where it's not mandatory to notify. You're not under the national security test. It's not mandatory to notify under the existing national interest test. So there, there you're caught or you're potentially called in if there's a national security risk. Now, what we're going to be aiming to do here is to give as guidance to people to help them make that assessment. But we are, and of course, people can always come in voluntarily if they are concerned. I think, look, in the great bulk of cases, I think it will be pretty clear whether you're sort of subject to whether you have a national security risk or not. Obviously, I think channeling David Urban, the great bulk of investments that we see into Australia do not give rise to national security risks, and I think that's pretty clear. I don't know if Andrew or Malcolm want to add anything to that.
I might just to chime in there, Roger and Andrew. Thanks for your presentations. I think it's really important, and it's already part of the summary booklet, the indication of that voluntary notification, I think it's pretty clear the government is concerned about security issues. And when you've got a security issue running up the flagpole, it's pretty hard to then make a brave call. So, and against a backdrop of increased penalties and greater scrutiny, then I think then applicants should take advantage of that voluntary notification and come to you early and get some clarity if there is something that's in the grey area. I mean, as everyone should understand, we don't yet have the definition. So we're a bit ahead of ourselves when it's all said and done. And hopefully the consultation process will result in a definition that is pretty tight. And hopefully then we won't have too much in the grey. But of course, if there is a grey area, it is welcome that there is this preliminary process to go through with FIRB. But then I suspect the other side of that is a cautionary note that if you do make the brave call and you are called in, then I think there's, unfortunately, there's going to be someone at Treasury who will say, why didn't you use it? So I think the message there is if you are in the grey, I think take advantage of the process that has been made available, and I think that's obviously quite welcome.
Thanks, Malcolm. And thanks, Roger and Andrew. The next question is, and it's probably for yourself, Malcolm, is are indirect investments via Australian fund managers allowed? And if so, what is the process?
So the reforms and the temporary measures they've only done what Andrew and Roger have just described for us. They haven't gone into changes around definitions of what is a foreign person. So a fund manager can become a foreign person because of the investors in the fund. And there's no prohibition on that. And we've just gone through the presentation from Roger where investment is welcome, and it's all something that needs to be reviewed if you happen to trigger a FIRB notification requirement. What is really interesting and again is quite welcome, and to a degree also does pick up what's happened with CFIUS in America, is where the fund manager, as Roger's described, is otherwise a foreign government investor, but the investors in that fund aren't active, they're not in any position to decide on strategy or direction of the fund, they are simply passive, and if there are small investors, small proportions, then they're going to get the benefit of the thresholds, which is really welcome and will actually, I think, be of great assistance to bringing investment back into the country, because quite often it's seen with these small fund managers who are buying small interests that are otherwise just not on FIRB's radar, but because they've got some pension fund or something that's government connected offshore that probably doesn't even know where their money is going. They've simply put their money into a product and they take a return at the end of the day. That reform is really welcome. And so those sorts of fund managers are continuing to be able to invest in Australia with that indirect ownership by foreign persons. There will be occasions where they will meet the threshold, will still need to go through the third process. But overall, that's a welcome change. And so really for fund managers, they are still foreign persons if they have that ownership. So the measures haven't actually changed that. But good process, good reform coming.
Okay, thanks, Malcolm. And I suppose that's a real reach out to all of the advisors out there to make sure that their clients fully understand the definition of their business in terms of a foreign person, etc. The next question that we have come in is, what is the average processing time for applications now, noting the changes to the framework?
Okay, so I guess, like, obviously the new framework hasn't come into effect. So, but in terms of what we're seeing in terms of case processing times, we recorded, I think it was a median time of about 45 days as part of our last regulator performance framework. I'm sort of relying on memory here. I think it was about that. What we try and do, wherever possible, is work with applicants to meet the commercial timeframes. So the 45 days is clearly longer than the statutory time frame of 30 days. We work with investors to extend those statutory timeframes because, frankly, often it is not possible to get all the information and decision done within 30 days. So that's why this process, and we've really sort of, I think, picked up this process even more given the temporary $0 threshold changes, is to work closely and quickly with investors around commercial timeframes to meet those commercial timeframes wherever we can. And I think Andrew mentioned that we have been able to turn around cases quickly where that has been needed. And as part of the government's announcement, they said, naturally enough, that we would be focusing on those investments which had an impact on jobs and investment. So that's obviously a key thing we look at in doing that. But we recognise that processing times is an important factor, something which we keep a close eye on. And we are, I think Andrew mentioned, we've brought on more staff, we're putting in place new processes, all designed really to increase the output of cases at the current time.
Okay. Thanks, Roger. So I've got some other live questions coming in, but I'll keep moving through these pre-submitted questions. The next one, it does have three parts, all connected. The first part is, what difference will the 6-month deadline make? Second part is, will FIRB actually take 6 months to deal with approvals, which I think, Roger, you partly answered there. And will there be any difference in approval times between Chinese investments and those from elsewhere?
Look, we treat every case on its merits. So I think that's all I can really say to that. As I say, we're prioritising investments that support Australian jobs and investment, and obviously some cases are more complex than others. Like critical infrastructure generally will be more complex, take longer time frames than investment in something that is poses generally less concerns on the national interest. So that's how I would answer that.
Yeah.
Look, I might also just jump in there as well, Matt and Roger, to just give some experience that we've had in terms of dealing with Treasury during this period. And what Roger's saying is absolutely right, that where you come with a proposal that's urgent, where jobs are at risk or business continuity is threatened, to their credit, they have been pulling out all stops and turning things around very quickly. And for a couple of our matters, I can say they have involved Chinese investment where there's been some construction work that funding was required urgently, or if it didn't come in, then jobs would be lost on site, or at least laid off until the funding came through. So, and FIRB have reacted to that and moved very quickly. So there are a couple of examples of that, but it is about coming in with that urgency and getting to that priority. Matters that don't have that urgency attached to them, they're going to take a bit longer in the current climate. I think that's just a fact of life.
Thanks, Malcolm. And I think it's worthwhile to emphasise that some of the most celebrated FIRB cases where it has been rejected have not involved China, and quite often there's issues around ACCC matters that FIRB considers as well. So it's not always about security; it covers other areas as well. The next item there is again probably for yourselves, Roger and Andrew, is around how do the latest reforms compare in an international context in terms of other countries tightening up their foreign investment regimes?
Yeah, thanks. I think, I guess in a sense, Roger and I painted a bit of a picture both around international changes with respect to COVID-19, so temporary measures that other countries have put in place. But Roger's also pointed to some fairly profound changes across the world that the OECD has been tracking to sort of indicate that 9 of the world's largest 10 economies have made changes to their regimes. So I think, the one thing I would add to that is to just observe that that there is a degree of commonality across those. There will always be differences in what countries consider to be in their national security or essential security, depending on how you want to describe that. And there will be differences in the way that they construct those regimes. Those can be a little bit dependent on where they've come from, but also the legal framework that they operate under. But I would say that there is, in a sense, a degree of convergence here in the ways in which we screen things. So Australia will not be unique in having a regime which has partly a mandatory notification scheme built off the regime that we already have, but also recognising that some areas the risks are more significant and are more conducive to pre-investment approval, but it will also have a call-on arrangement. The US has recently instituted a similar arrangement by moving from what has historically been an entirely call-in based regime to one which now includes components of mandatory notification. And equally, New Zealand has recently just been through a similar process and just enacted some reforms in the last few weeks. So I guess I would say that how do they compare? Well, they compare in the sense that they're converging on recognising similar risks and converging to a degree in the ways in which those are managed through the foreign investment processes that we each have in place.
Thanks, Andrew. And I think the benefit is it's providing far greater clarity around areas that arguably were obvious, but in the absence of clarity, involved advisors steering state enterprises down a path of thinking they could acquire something that realistically they couldn't. And I think this new set of rules provides a greater level of clarity that will help investors make sure that they invest in areas where they have a genuine chance of succeeding and don't sort of incur significant costs on transactions that really were never going to go ahead. The next item there is around, again, obviously being an ACBC event, these questions come through around, will there be any further restrictions or conditions placed on Chinese state-owned entities when applying for FIRB? And obviously, Roger, I think you've answered this a number of times already today, but maybe just one more time and then we'll leave this item alone.
Yeah. Well, so we've got the national interest test at the moment, and as I said, that will continue. The types of issues that we look at will continue. We have a non-discriminatory case-by-case approach to foreign investment.
Thanks, Roger. Last of the pre-submitted questions is, what sectors are investors interested in now? So what are you seeing? And has that changed? Are investments being approved, or are there any issues or concerns from government?
Well, Malcolm's probably as well placed as anybody to talk about sectors of interest. Look, I think there continues to be a lot of interest in investment into Australia. That is absolutely the case. We continue to get very heavy interest, and I think across a wide range of areas, including the services sector, mining sector. I think it's pretty broad ranging. It would be my sense. I don't know. Maybe Malcolm. Maybe you could have a perspective.
Yeah, look, I'd agree, Roger. I think in terms of at a time of the crisis, I don't think we're seeing investment that you would say is aimed at picking up bargain prices or picking over carcasses, I think was suggested at one point. I think we're actually seeing good investment, and it's right across the board. As you say, it's mining, there's commercial property is still very hot, a lot of development in that space. Renewables is an interesting area where there is a fair deal of investor interest. So I think it's one of the things that given that interest, despite the fact that we're at in a crisis period, that we do have some temporary measures in place and we do have a reform package, that it means we must be very sensible and careful with messaging. That yes, we've got a new reform package. Yes, it's got a new security and there's greater compliance and so on. So yes, there's some difficult aspects to it, but equally we need to balance that with there are relaxations and there are improvements, there's streamlining, and there's a whole range of measures that are designed to assist foreign investment. So, and I think it's incumbent not to focus on the negative. And you've only got to look at what happened with the 6-month deadline. That was widely reported as, FIRB's now going to take 6 months, end of story. Whereas in fact, the reality is vastly different. The messaging by the media in particular, or people just taking the negative, it can have a damaging effect on investment. Thankfully, so far, we're still seeing healthy investment coming through. And we've got to make sure we promote that. If the economy is to pick up and get going again, it's really important. Foreign investment is something that the country relies upon. I think Virginia said it in her opening remarks that it's a linchpin to having a good economy, and we need to foster it, not put a roadblock in front of it. And that's what FIRB does. It monitors, and I think David Irvine describes it as facilitating investment.
Thanks, Malcolm. And I suppose a question to all of you, do you get a sense that obviously for anyone wishing to acquire assets overseas, site inspections and physically being on the ground with delegations to run a process is quite important. It's probably even more critical in Asian cultures and China in particular. Are you getting a sense that there's a warming up for a wave of investments once the aviation sector sort of fires up again and people can actually physically inspect assets and sort of touch and feel what they're looking to invest in? Or is it really just a standard sort of application process you're seeing that's coming through?
Maybe I'll start on that. It's interesting. I think the fact that there is a good stream of investment is suggesting that it's about the financial rather than the hands-on operation. So hands-on operational, you go down a separate path with FIRB. What sort of access are you getting? If you're in critical infrastructure or you've got sensitive tenancies in a property, there's a range of issues that you need to address. And that in a sense is starting to look at what is the national security issue anyway, and that'll be addressed going forward in those in those proposals that are lower than the current thresholds next year. But I think the investment culture is one of we'll put money in and we'll get a return. Use the local managers, use the fund managers. Going back to that earlier question, it's a financial investment rather than the touch and feel. So it is interesting that with that non-access we've got at the moment, that the streams of investment are still coming without touch and feel.
Yeah, that's very interesting because historically, it's, as you know, Malcolm, it's very much about the delegation coming down from China in that regard and doing their site tours and visits. So that's encouraging to see that this more virtual sort of due diligence process is starting to get some traction.
I think it was about assisting our tourist sector as well. I think we should nevertheless encourage the delegations to come because the tourism sector is obviously struggling. So we shouldn't ensure that that still happens. But I think it's interesting that the income stream, the investment streams are there despite no touch and feel.
Yeah, certainly. This is I've got a question that's come through from one of our own, and we run at ACBC, there's a health-focused accelerator program, and part of the role is to facilitate investments for Australian healthcare startup companies. Most of the size of the investment is less than 1 million, and all of them are under 5 mil. So obviously, we need to help investors to go through a FIRB process in this instance. And given us the size of the investment is quite small, what do you think is our best approach to help investors with these applications?
Well, look, I'm happy to sort of, I guess, kick off. So the advice we generally give to anybody is, particularly if they're not familiar with the FIRB process, is to it's a regulatory process. So engaging with a lawyer, somebody who's got some familiarity with the FIRB process is a sort of a good starting point. But we run a phone line here. Very happy for people to pick up the phone, send us an email. We are obviously engaging with at the moment quite a few applicants who similarly would not normally need to come into the system. So we are ourselves, I guess, getting more experience in dealing with those sorts of applicants.
Thanks, Roger. Just a question from the audience. So here's one. Will there be any change to the existing exemption certificate available under Section 58 of the FATA?
So there will be, under the reform package, some changes to the exemption certificates that will be made available. So there are two circumstances that are contemplated in the summary booklet. One is exemption certificates which are designed to allow investors to not just seek safe harbour with respect to an individual application, but to in fact come in and receive an exemption certificate with respect to the new national security test arrangements. The second kind will be one of the limbs which gives effect to the streamlining measures that Roger outlined, that some of that streamlining will be given effect through changes to the regulations, which will, in certain circumstances, those circumstances being where there are multiple different foreign government investors from multiple countries in a fund, which in aggregate lead them to be considered to be a foreign government investor despite having no influence or control. That will be done through regulations. Circumstances where in foreign government investors from a single country make up 20% or more of the investors in a single fund, they will still be required to submit, but they will be able to apply for and obtain a exemption certificate where they're able to demonstrate that all of their underlying investors are purely passive. So there are two different changes designed to achieve some deregulatory and streamlining initiatives as part of the package.
Thanks, Andrew. Next question here is around the last resort element of the new legislation. So I'm just working our way through this. And will there be any restrictions imposed on the exercise of this power? For example, a time limit, industry, sector, or other criteria? So there's a statement that says the last resort power is far-reaching and will potentially create uncertainty for investors. Will there be restrictions imposed on the exercise of this power? For example, time limit, industry, sectors, and other criteria.
So, so it's probably worth talking about both the call-in power and the last resort power, because how these things sort of fit together and work. So, so the call-in power is where you haven't got an approval, but there's a capacity for the Treasurer to screen you because there's a concern around national security. And this is where Malcolm was talking about this grey area. You can get safe harbour, etc. But if you don't notify, then the idea is that there will be a period of time where you can be called in. That period of time needs to be worked through, but the idea is that there will be a period of time. The last resort power is different in that you've already got an approval, but there's been a change in circumstance, which means that essentially a new national security concern arises, and the summary booklet, Andrew can probably explain it more eloquently than I can, but there's been a change in circumstances, and that would then, there's a range of safeguards around that, but that would be the circumstance in which that approval could be varied, or as an ultimate last resort, if you like, the approval could be, if you like, overturned or revoked. So I don't know if Andrew, you want to explain a bit further on that?
No, I think Rod's covered it. I mean, so I think to come back to the very sort of precise points, therefore, will there be a time limit? No, there won't, with respect to the last resort power. Is it targeted at specific industries? No, it is not. And will there be safeguards? Yes, there will be. The summary booklet points to what some of those may be. And as we go into the exposure draft consultation phase, there will be a significant period of time provided for people to see the detail of those safeguards and an opportunity to comment on this.
So would it be fair to say that it is a last resort, and that before you get there, in the summary paper, there's also reference to an ability to give directions? So that we're talking about when there's been an approval and something's happened, something's gone wrong, or a new security issue's arisen, or there's a problem with conditions. Would the directions power then be able to be used before you got to the last resort?
It may be used, Malcolm. I think, as you say, it will come down to the circumstances.
Yeah.
Concerns that are raised, particularly if it is with respect to an issue that has arisen against a condition that may have been imposed. And then what you've just outlined there, there will be an increased range of options available to the FIRB as a consequence of these reforms, which will give us more flexibility and proportionality in the tools that are available. And the last resort power, as you say, is a last resort.
Thanks.
Okay. Another sort of more technical question here from the audience, and this relates to commercial leases. The question is, with commercial leases, if a lease is under 5 years in duration, but the parties agree when entering into the lease that they will extend the lease or enter into a further term subject to FIRB approval, is this a scheme to avoid the temporary measures?
Malcolm, would you like to have a go?
Sounds like legal advice. Look, my view is that if you're going to FIRB, then you're not involved in anti-avoidance. Clearly, if you've got a lease for a term less than 5 years, that's not an interest in land. If the parties want to then go to FIRB and seek an approval for a term of more than 5 years, how can that be anti-avoidance? You're actually seeking the approval of FIRB for that. So I think that's okay. It's the ones where if you enter into agreements with rolling less than 5 year terms, that the parties do agree that and no one goes near FIRB, that's clearly a problem. But the fact that, as the question asks, it's entering into a 5 year term, then going to FIRB for any more, that's clearly what the legislation wants everyone to do. It's akin to, in the corporate sense, someone going to acquire a 19.99% interest in a company, which you can clearly do, no problem. But your intent is to go higher, and if you go higher, you go to FIRB because you're going to hit the 20% threshold, or 10% if you're a foreign government investor. That's never caused anyone any problem. So in the same sense, you can apply that thinking to a lease. Is it reasonably likely at the time it's entered into? That's a question that comes up because that's slightly different to the corporate sense. I don't think you can say it's reasonably likely because you need to get your no objection notification from FIRB. And FIRB will tell us that they will never be able to say what the Treasurer is thinking. So it can't be reasonably likely because none of us are going to be able to put into the Treasurer's mind what his decision is. That's why you're going to FIRB. That's why it won't be reasonably likely when you enter into it if you've got it conditional on FIRB approval. So I think that's okay.
Thanks, Malcolm. Just there is one question sitting here that I think you guys have touched on, but in fairness to the audience and the member who submitted the question, we might just recap and make sure we're clear on it. And it relates to the time frames on the call-in aspect versus the last resort power. And the question is, how long will the Treasurer, or can they call in for an approved case? Is it indefinite, or is there a time frame for a call-in?
So the summary booklet says it's time limited. So it is limited by time. That's clear. We haven't specified, or the government hasn't specified a particular period yet. But that's to be worked through. But yes, it won't be indefinite.
Thanks, Roger.
I guess in terms of there's obviously a balance of considerations here between giving enough time that we could identify what might be a risk and take action, with the other consideration obviously being the desire to give people that once a period of time has expired, that they're not going to be called in. So I guess it's, to my mind, that's the balance we need to strike in that particular one.
And probably just the final one from the floor, so to speak, is I think it's around, this is specific to farming and agriculture. And it's a fairly open-ended question, but the question is, will there be any other foreign investment changes to regulations for farming or agribusiness enterprises for state-owned or private investors? And I think this is in the context of obviously anything that's neighbouring a sensitive facility. I think that's well understood, and similarly anything that's sort of ACCC related is well understood. Is there any other sort of examples that you're coming across, or believe that it needs to be made clear that within the new rules there could be potential impacts for the agricultural sector?
Well, we've already got pretty tight rules on the agriculture sector. A cumulative test of $15 million, a lower threshold for agribusiness. So there's no intention to change those thresholds
I think that's the answer they're looking for, which is good. Now, I might just, does anyone have any closing remarks? I mean, is there anything that you feel we haven't covered today, or you'd just like to sort of touch on before we draw the Q&A session to a close?
No, look, just again, thank everybody. Terrific lot of questions. Shows a great degree of engagement on the issues. It's been really nice.
And thank you for inviting me to participate. And I think we'll certainly be encouraged. We are encouraged by a longer consultation period this time than the rewrite of the legislation in 2015. I remember trying to look at the new law on a phone in Fiji on school holidays. So this will be a much better consultation process, and look forward to that. And thank you guys for participating as well.
Yeah, so thanks, Malcolm. And before I depart, I'd obviously like to thank Andrew and Roger for their presentations today. I thought they were outstanding, and as I said, I think it's a vast improvement and on the rules, gives far greater clarity, and I think that will be very well received once everyone gets a chance to properly digest the changes. And Malcolm, thanks again for joining us, and anyone who has a Collingwood Football Club in the background in a session that I'm moderating is always welcome, and your presence is gratefully received. So thanks for joining us today, and we look forward to catching up soon. I'll pass back to you, Virginia.
Thanks, Matt. And I just want to really concur with Matt's comments. That was a terrific conversation. I think Malcolm's comments that, yes, we've got a new package, yes, there's greater compliance, but greater relaxation, improvements and streamlining. And of course, it's the opportunity for a foreign investment is something that Australia does rely on, and it supports the priority of growth for Australian jobs. So I think that's a terrific. Thank you all very much for participating. I look forward to getting the information. We will send out to all our members and participants, so that there is obviously feedback. So we look forward to receiving that in due course. And in final closing, apart from our wonderful speakers and Matt, Andrew Fay, Associate at King & Wood Mallison, was the catalyst for this event and has pulled a lot of things together behind the scenes. So Andrew, I do thank you as well. So we look forward to seeing all of you again very soon. Keep your eye on the ACBC website for upcoming fabulous events. So thank you all very much.